Welcome to another episode of The Wealth Managers, and today I have with me Sandeep Das, Head Private Banking India at Standard Chartered. Sandeep, pleasure having you on the show. You know, we at ET now always encourage people to learn themselves, become financially sound, become financially aware. Why then a need for a wealth manager in the first place?
It's over time, Aisha, wealth has increased and the complexities have increased. Volatility has come in. So India is seeing, after years of rise in the markets, especially equities, India is now seeing a period of significant declines and increased volatility. So you need to have a wealth partner next to you to keep on advising you on your investments and your next steps.
But I guess the need and the want of the clients would vary from client to client. What I need from my wealth, or what I need my wealth to do, is completely different than yours. So tell me about the various client categories that come to you and seek advice.
There are about 5 client categories. There is the ultra high net worth clients, which are multi-generational industrialist families. These are billionaires and a few self-made billionaires as well. Second is large and mid-sized promoters with accumulated wealth. Third, senior corporate professionals. Fourth, other professionals such as actors, sportsmen, artists, doctors. And the fifth is non-resident Indians. Let's not forget that there are 260,000 millionaire non-resident Indians, and all having a resurgent interest back into India. And I think with Standard Chartered, with a platform across from Africa, London, Singapore and Dubai, we are able to cater to that.
Yeah, a lot of wealth is outside India with Indians. But tell me, you know, when it comes to these individual categories, where do you think the challenge lies? I mean, when you say HNI, again, within HNIs as well, everyone's need is different. Someone could be first generation entrepreneur, someone just wants to leave money behind for their next generation, and someone just needs will management. Their needs, again, are very, very different. So what are the different categories within HNIs as well that you're currently focusing at?
Each client family is different, you know, either via family charter or by special situations. So entrepreneurs are building wealth continuously, and depending at what life cycle they are in, you're looking at either preserving their wealth or you're looking at transferring their wealth to the next generation. On the other hand, you have senior corporate professionals who have ESOPs, and they are vesting their ESOPs and creating new pools of wealth. Let's say there's another category of promoter families who are exiting their businesses fully or partly, perhaps because the next generation doesn't have the same passion for that business, or they want to cash in or what the valuation of their business is and move on to do something else. If you look at professionals such as perhaps sports persons, you know, they have probably a shelf life which is, let's say, of 10 to 15 years. You got to accumulate wealth, keep on accumulating wealth, and then have a plan which lasts them for the rest of their lives.
Okay, so where would you say is a bigger challenge? I mean, is a bigger challenge the sports persons because their shelf life, or for that matter, you know, some of the actors, wherein you know that the number of years that they're making money could be just very limited. Their career span in that sense is very short, and they need that money to last them for an entire lifetime? Or would you say that it's the millennials or the extremely learned salaried class because they know so much that it's difficult to convince them and mold them into what you want them to be?
Maybe two aspects. So let's take the senior corporate professionals. Lots of money in ESOPs, but extremely time starved and time poor. So therefore they need a wealth manager who will advise them on their asset allocation, on their investment objectives, and execute them. The third, I think you interestingly pointed out, across all the client categories, there's an underlying client sub-segment client category, which is the next generation. And the next generation is typically millennials. So the way wealth managers need to engage with them, need to find out what their interests are, need to recognize that wealth will eventually get transferred to the next generation, the millennials, is very interesting, and you need to adapt to that. For example, let me give you an example. We run a program in Standard Chartered called Future Leaders Program, which focuses on clients' children aged between 20 and 35. And we run programs for them across 5 pillars: leadership, entrepreneurship, philanthropy, sustainability, and communications. How do we help them represent their families and country at the global stage? How do we build them? How do we get them to build up their leadership styles? How do we get them interested in philanthropy and contributing a part of their family wealth into such objectives?
Good causes. So where would you say is the challenge segment? As a wealth manager, who's the toughest client out of these 5?
The non-resident Indians, because they are in a different time zone, and how you interact with them. So if you have a non-resident Indian client, you're working beyond 9 to 9. Okay, so that's one, right? You're working across different time zones. You need to understand regulations extremely well, what they can do in India and what they can't do in India. So I would consider them as a challenging segment, but a very interesting segment. They have huge revival of interest in India, followed by the millennials in terms of, having the right engagement platform in place for them.
They know too much, yet they're confused, right?
They know rightly the right things.
Yeah. So is there any behavioral pattern or any particular thing that stands out when you deal with clients? Are there behavioral biases in each of these 5 categories?
There are perhaps 3 behavioral biases which we see in clients, and we see in ourselves as wealth managers as well. So let me give you bias 1, endowment bias. Clients who have legacy holdings in direct equity stocks which they purchased for some reason many years back, continue to hold on to that. Real estate, continue to hold on to that, and looking to exit at a particular price, irrespective of what the fundamental valuation of that is. So that is an endowment bias. The second is a recency bias. If one has suffered a loss in a particular asset class, perhaps a few years back, one is averse to investing in that asset class in, again. So that's, let's say, a loss aversion or a recency bias. And third is a representative bias, which is that if past performance of an asset class has done well, you continue to invest in that, or vice versa. And therefore, you're not looking at what the future potential of that investment may be.
Traditionally, the client profile that you mentioned has always looked at lots of gold, lots of real estate, and not as big a part into equities or financial market products, for instance. And I'm not talking about the corporates, but I'm talking about the HNIs, the billionaires, the celebrities, quote unquote. Okay. How difficult is it to actually change their mindset, to try and divert them to financial modules?
I think slowly but surely that shift is happening.
Newspaper headlines are working well?
Well, newspaper headlines of marketing real estate projects also probably counterbalances that. But let's look at some data. So you have clients' allocation towards real estate was about 36% for high net worth individual clients in 2011. That is now 27% in 2017. So there has been a shift from physical assets to financial assets, and we see that only continuing. For example, you have, $877 billion of wealth among high net worth individuals in India. But this does not capture real estate holdings, which is a very significant amount. So if you, let's say, one research report said 18% of high net worth individuals is in real estate, then that itself comes to close to $200 billion. So there is a lot of money which is moving from physical to financial assets, and you will see that only increase.
So we've established the kind of clients, 5 categories, their behavioral biases. We're going to take a very quick break, but when we come back, we'll discuss with Sandeep what are the challenges that a wealth manager has to face and what really is a typical day in the life of a wealth manager. Back with the wealth managers and still in conversation with Sandeep Das from Standard Chartered Bank. Sandeep, we've established the 5 kind of clients, their behavioral biases. But given the time that we're in right now, you know, start of the year, if someone asked you how much would you put in a debt fund, fixed income, the answer would have been completely different than the world that we're in today. Typically, what kind of asset allocation advice would you give to someone at a time when gold, real estate, nothing is working out, it's only the financial products?
So let's take a step back. If you look at India, domestic macros remain resilient. GDP growth is increasing steadily. Inflation is relatively contained. Twin deficits below historic lows, and structural reforms underway. Some of the key ones haven't already happened. It's important to note that asset allocation determines 90% of the variability of your returns. So having the right asset allocation in place is extremely important. Since 1990, the Sensex has seen 8 corrections more than 25%. So volatility, which I was talking about after periods of increase in equity markets, is now here to stay. So broadly, asset allocation depends on investors' risk tolerance, balancing liquidity with portfolio returns, understanding his risk profile. In short, as of current data, if broadly we stay bullish on and overweight on bonds, preferring short maturity bonds, we stay bullish on equities, preferring large cap equities, underweight on cash, and on gold there are diverging narratives, but we stay underweight on that.
And real estate?
Real estate is seeing gradual, slowly but surely, assets moving out of real estate into financial assets. So that's over a period of time, and it depends on your particular situation and your family's charter and in terms of how much real estate you want to have across cities.
Does it get tough though to convince them to put money in bonds and go easy in real estate depending on how much inheritance they already have?
So having the right asset, I think the moot point is have the right discussion. Have the discussion to understand the client's risk profile, time horizon, and then determine the asset allocation plan. Review it periodically and then determine what investments need to be executed.
Where would you say is the challenge in wealth management? What's the toughest thing about your job?
For the industry, let's say wealth management industry, a few challenges. One, be aware of disruption. Be aware of not technology, but be aware of technology-enabled business models which can come and disrupt your business.
You mean bots taking over financial advice?
Which means keeping a close eye on, you know, what's happening on robotics, machine learning, robo-advisory, and keeping up and pace with that. 2 is looking at collaboration rather than competing. So we should learn how to collaborate with fintech firms who have probably carved a niche for themselves. As and when the market is ready, you would have done the pre-work to look at how you can collaborate with a fintech firm to be able to give the solutions to the clients. The second is investments. Clearly, one needs to invest in infrastructure, sophisticated product platform, invest in scale to build people, invest in upskilling people, front office, mid office, back office, because together they serve the client. Fourth, talent is in short supply. So work on getting enough talent, and perhaps being part of a universal bank, we have access to RMs from corporate banking, commercial banking to come and help us in the wealth management space.
Absolutely. Where do you see wealth management growing? Is wealth management still restricted to the tier ones of India? I mean, is it only Bangalore, Delhi, Mumbai, and maybe parts of Chennai seeking advice? Or do you see now wealth management as well growing along with Wealthy India, which is beyond these tier ones to tier twos and tier three cities as well?
So, metro top 5-6 cities contribute 60% of high net worth individual wealth in terms of number of clients, and 40% is coming in from all the other cities. And cities to watch out for are going forward Ahmedabad, Pune, Coimbatore, Nagpur, Ludhiana. And the nuances of each market is very different. So what works in Guwahati possibly is different from what works in Coimbatore, and so on and so forth with Ludhiana and Nagpur.
Absolutely. Again, you know, personally as a wealth manager, what would you say is the toughest part of your day?
Is keeping ourselves relevant, in pace, keeping ahead of technology disruption, and making sure you keep on upskilling your team to be relevant to clients. I think one particular underlying theme is in today's day of information deluge, you know, how do you add value to time-starved clients? So there's reams of information there. So I think the prize goes to somebody who can do the most sense making of all the reams of information, are able to communicate that to clients through you know, multi-channel interactions. So multi-channel, not just face-to-face, but really multi-channel interactions.
Is it a tough job? What's life in a day of a fund manager?
It's fun, absolutely. Yeah. It's an early start. So I think for all wealth managers, the day starts early. You come in early to find out what happened in those markets which closed later than India the previous day. You find out what has happened in the global markets which have opened earlier than India.
That sounds like our day. Yeah.
True, we keep pace with you. And at 9 o'clock when the markets open in India, you ascertain what the trends are. So that's how the day starts. Then it quickly
So it's daily monitoring of equities, huh?
Daily monitoring of not just equities, of all the trends across all the asset classes. Second is you talk to a few fund managers, you talk to product specialists to certain trends in the market and opportunities. Thereafter you go and meet clients. You travel from Nariman Point to Borivali to BKC and you do your client meetings, because face-to-face interactions really help in our kind of business. And then there is housekeeping work to make sure that you are ready with the portfolio reviews and client has got all that information. And essentially it's a 24/7 job, because if you have NRI clients, you work across time zones. Anyway, any client in India can call you at any time 7 days a week. So you got to be updated, relevant, and be able to interact with the client.
Be on the ball. I'm sure you get that query as well. So, you know, while one is convinced about wealth management and why there is need for people like you to professionally run your portfolio, and by portfolio I mean not just equities or you know, bonds, but across the board, your wealth, your assets, all of it. But how is it that you choose a fund manager? Because this is not like a mutual fund advice only, where I go to a website and see what the previous record is like, how many jobs has he changed, what are the funds that he's managed, what are his top picks. It's more than that, lots more than that.
So it's just not the technical skills. It's a lot of behavioral skills as well. We try and upskill our wealth managers in EQ. That's important, because as they interact with colleagues in the bank or with clients, that's very important. Running meetings, for example. So if you get 30 minutes with a client, how do you pitch? What do you cover? What do you focus on, and how do you ensure that you execute the actions which you've committed to? So it's across a whole lot of things in terms of technical, behavioral, and being able to connect with the client by having elevated conversations. I mean, when you're talking to millionaire and billionaire clients, you must know enough about their passions, their business, their interests. So there is a lot of work which you have to do to continually keep yourself you know, learning, right? That's the fun of the job, because you keep on learning.
What's the mood like right now amongst your clients? Are people a little risk averse? Because what you're seeing in the market is something you've not seen in the past 20 years. So the question on everyone's mind is, when is this long-lasting bull run going to finally pause? Are people risk averse right now, or they're just all guns raring to go? They're like, invest it all, I don't want to sit on cash at all.
Now is not the time to go all in on risky assets. So that's clearly the message out there. So now is the time to go back to basics, ensure that your right asset allocation is there, ensure that you have the right investments to counter riskier assets. Equities is across the spectrum. So you have large cap, mid cap, small cap. At different points in time, each equity class underperforms or over delivers. So for example, and that's what we tell all our clients. So if the asset class changes in terms of performance every year, 2017 high returns came from mid caps, 2016 from long-term bonds, 2015 from short-term bonds. So how do you know what asset class is likely to do well this year? So those are the questions you need to answer and discuss with your client.
So what are you telling them right now? Which is that asset class which is going to perform from here? I know it's been the year of the large caps, but what next?
Yeah. So broadly we stay bullish, but overweight on short-term bonds and on large cap equities.
As of date?
As of now.
For the next 1 year?
It keeps changing. So.
Okay, but for 2019, if you had to crystal ball gaze and make a prediction, which asset class do you think will outperform across categories?
So, as Aisha, you spoke about, the US is seeing a long bull run. And normally when you see a long bull run, the equities do well in the late stage rally of the bull run. So that's what you're seeing in US equities. And all markets are kind of interdependent. So what happens in Turkey impacts us in India in terms of the rupee. So that's why we stay bullish on equities, but this is, you prefer margin of safety, so therefore large cap equities.
So it's getting to that euphoric phase, you believe? It is. Okay. On that note, thanks so much for taking the time.
Aisha, thank you.